U.S. stock markets saw significant swings after the Federal Reserve introduced a 0.5% interest rate cut, larger than some expected, marking the start of a new round of monetary easing. While the initial response was a surge to record highs, these gains dissipated by the end of the trading session, as some investors were unsettled by Chair Powell's indication that the Fed might not maintain the same pace of cuts moving forward. Despite the pullback in broader markets, small-cap stocks and cyclical sectors outperformed, benefiting from the interest rate relief. On the bond front, yields, which had been hovering near their lows for the year, edged higher as the Fed's updated projections pointed to a slower rate-cutting trajectory than the bond market had anticipated. Meanwhile, oil prices slipped, and with crude hovering around $70 per barrel, lower gasoline prices could provide a boost to consumer spending and the economy in the coming months. The Federal Reserve made its first rate cut in 4 years, following the most aggressive tightening cycle in decades and an extended pause. The Fed slashed its benchmark interest rate by 0.5%, a larger cut than usual, in a move that Chair Powell emphasized was aimed at staying ahead of potential economic risks and guiding the economy to a soft landing. With inflation gradually aligning with the Fed's 2% target, policymakers are now focusing more on preventing employment from weakening. Today's cut marks a key step in easing monetary policy over time. The Fed's new target range for the federal funds rate is 4.75% to 5.0%, down from 5.25% to 5.5%. According to the updated rate projections, or dot plot, officials anticipate 2 more quarter-point cuts this year, 4 in 2025, and another 2 in 2026, eventually bringing the rate down to 2.9%, which is considered neutral. Despite the large cut, the Fed expects the economy to remain resilient, with inflation returning to target levels next year and unemployment peaking slightly higher at 4.4%. The market's reaction to rate cuts often depends on the broader economic landscape. Historically, when rate cuts occur without an accompanying recession, stock markets tend to perform well over the following 12 months. However, cuts made in response to economic weakness can lead to losses. In this case, we view the Fed's move as precautionary, cutting rates because inflation is under control, rather than due to urgent economic concerns. Strong recent data, including retail sales and industrial production, led the Atlanta Fed to raise its GDP forecast for Q3 to 3% from 2.5%, signaling continued robust growth. Consumer spending remains solid, and the rise in unemployment appears to be driven more by an expanding labor force than layoffs, both of which point toward the possibility of a soft landing. If a recession is avoided, we expect the current bull market to endure, though not without some volatility. Cyclical stocks and those with lower valuations may start closing the gap with megacap tech companies. In fixed income markets, historically lower rates have led to positive returns for investment-grade bonds, and we expect this pattern to hold. However, the prospect of steadily falling rates brings reinvestment risk for short-term cash investments compared to longer-term bonds.